So, investors are terrified as stocks from giant tech are collapsing. What is happening to the stock market, specifically tech stocks? Because Amazon has seen a 20% decline in its stocks on the 27th of October. It represents roughly 2 to 3 years worth of gains wiped out in a single day, and they said crypto was volatile. So the main reason we have to address what's happening with tech stocks right now is that tech represents roughly 25% of the S&P 500's, or the stock market's value. In fact, Microsoft, Google, Apple, and Amazon, just those four represent about 20% of the S&P 500's value or market cap. And we just got earnings reports from those companies, and we don't think we have seen losses that big from major tech companies in our entire lifetime. Hi guys, welcome back to Glory Investing Show, and in today's video, I'm going to tell you why big tech stocks are plunging. What is happening right now? According to a report published by CNBC on September 13th of this year, the 6 largest U.S. tech companies lost more than $500 billion in value after an unexpectedly high August inflation report sent tech stocks tumbling. The Consumer Price Index was up 0.1% for the month and was up 8.3% year over year, even as gas prices fell. And after that, Meta lost $700 billion, and its stock price right now is at its lowest point since the beginning of 2016. And their market cap, which is at $266 billion, is roughly $50 billion less than Home Depot's. In fact, Meta's stock price got so bad that even Jim Cramer went on CNBC and he got super emotional and he had to apologize for his belief in the company and getting it wrong. But it's not just Meta. Microsoft and Amazon are also to blame, as they also lost significant value. Their earnings weren't really that low, which is what makes it absurd. The bad part of their guidance, which is what they say investors will happen soon and implies that the recession will worsen, was what they said about what they expect would happen in the near future. We, therefore, aim to explain the reasons behind the collapse of tech stocks in today's video and what this means for the global economy. Why the stock of Meta plunged. Shares of Meta Platforms, META, plunged 24.56% on August 27th, wiping out nearly $85 billion from the company's market value in its biggest one-day drop since February 3rd. And that has spelled bad news for some big mutual funds holders. Investors sold shares following disappointing third-quarter earnings results, which led Morningstar senior equity analyst Ali Mogharabi to cut his fair value estimate for the social media giant to $260 from $346. While Meta's revenue for the third quarter of $27.71 billion beats forecasts of $27.44 billion, earnings per share fell short. The firm reported earnings per share, EPS, of $1.64. Below consensus estimates of $1.90. Meta's share price went down to around $100 a share, which is the lowest level since around 2016. The biggest reason is that their income has been going down and their expenses have been going up. Their overall net income is down by 52% in quarter 3 of this year, and their expenses are up by 19%. But what's crazier is how much money they told us they're going to spend just to operate their business this year, which is anywhere between $85 to $87 billion. But another reason is what they've told us they'll spend next year. That's estimated to go up between $96 and $101 billion in 2023. And the reason that this is huge is that last year was Meta's most profitable year when they made $117 billion. But they're telling that next year they're going to make less money and they're going to spend more money. Investors don't like that, so they'll sell the stock. Another major reason the stock is selling off and going down is that investors are losing confidence in the idea of the metaverse. This was the whole reason why Facebook changed its name from Facebook to Meta. But since doing that, they've already lost over $500 billion in market cap. Meta is already losing money, and one more reason for that is that there's also pressure from TikTok. People are spending less time on Facebook and advertisers are paying less money for ads. If you combine all of those reasons, this is why Meta's price is going down. The performance of Amazon stocks. Amazon shares dropped close to 20% in after-hours trading in October after the company said its all-important holiday shopping season would be smaller than expected. The company is the latest tech giant to disappoint Wall Street. After enjoying phenomenal growth during the pandemic, Amazon has struggled to contain costs as inflation and rising interest rates have taken their toll. The company has slowed the rollout of new facilities, leased out some warehouse space, and enacted a hiring freeze in parts of the business. For the 3 months that ended on the 30th of September, Amazon reported sales of $127.1 billion, slightly less than analysts had expected. Let me tell you that the company made a profit of $2.9 billion after 2 quarters of losing money. Amazon said that it expected net sales of between $140 billion and $148 billion in the fourth quarter, and analysts were expecting sales to come in at $155.15 billion. Andy Jassy, Amazon's chief executive, said he was encouraged by the steady progress that they're making on lowering costs in their stores, fulfillment network, and have a set of initiatives that we're methodically working through that we believe will yield a stronger cost structure for the business moving forward. There is obviously a lot happening in the macroeconomic environment, and we'll balance our investments to be more streamlined without compromising our key long-term strategic bets. What won't change is our mechanical focus on the customer experience, and we feel confident that we're ready to deliver a great experience for customers this holiday shopping season. What is happening to Shopify stocks? Shareholders of Ottawa, Ontario-based Spotify have watched in shock, and in some cases awe, as the company's common shares have plummeted to record lows during the past year as a result of the Fed turning hawkish in an effort to stop inflationary pressures from reaching record highs. This has occurred amid worsening macroeconomic circumstances, highlighted by declining consumer confidence and a deadline in real disposable earnings. The fact that Shopify is currently trading over 85% below its 52-week high has dampened expectations of explosive post-pandemic e-commerce growth. When the pandemic had already begun to spread, investor exuberance for e-commerce plays was vicious, as would be revealed by a time capsule to these earlier highs. This resulted in consumers staying inside to complete stay-at-home orders, which led to the closure of Shopify's brick-and-mortar retail locations. Because the valuation at the time was based primarily on the enormous optimism around the post-pandemic future, it was always going to be unsustainable. This allure of a world speeding faster into what was already its inevitable future led to a trading boom in Shopify shares as the company stood to benefit from this structural shift in human society. Indeed, since the mainstream adoption of the internet following the onset of the new millennia, e-commerce as a percentage of total retail sales has continually grown and sat below 20% in 2021, but is forecasted to grow to nearly half by the end of the decade. The revenue growth has slowed materially. The company last reported earnings for its fiscal 2022 second quarter, which saw revenue come in at $1.3 billion, up 16% from the year-ago quarter, but a miss of $111.8 million on consensus estimates. Companies about recession. According to the tech industry, they are making less money overall, and the money they are earning abroad is worth less due to the recession. The reason for this is a stronger dollar. Additionally, because they are importing fewer dollars, they have less money available to pay local employees, thanks to increasing inflation as well as the majority of their consumers using their platforms for advertising. This is how the majority of them make their money, and because there is less demand, they are also earning less money. Now, this will eventually have a ripple effect on other industries and areas because technology frequently sets the market price. That's all for today's video. I hope you enjoyed it. If you found this video helpful, make sure you smash the like button and share it with your friends. Don't forget to share your thoughts with us in the comments section below, and while you're here, click to watch one of the other 2 videos appearing on your screen right now. I'll see you there. Take care and stay tuned.